Hello, everybody. Good afternoon. My name is Jessica Leventhal with Precious Metals Summit Conferences, and I'm pleased to welcome you all to today's webcast, the first major keynote presentation we're doing via webcast. And we're very excited to have our three guests with us today. I'll be introducing Ross Beaty, Tom Kaplan, and Maron Katusa very briefly and let the gentlemen carry on a fascinating discussion for you today at a fantastic time to be interested in precious metals. First off, Ross Beaty is a geologist and resource entrepreneur. Many of you know him as the founder and chairman of Pan American Silver. He is also the founder and chair of Equinox Gold, which is a gold producing company that is presenting in this conference this afternoon at 3:45 p.m. Eastern Time. So be sure to catch the presentation for Equinox. Tom Kaplan is chairman and CEO of the Electrum Group, which is a privately held global natural resource investment management company. He's also chairman of Nova Gold, a gold developer that will be presenting at this conference tomorrow afternoon at 3 o'clock p.m. Eastern, so be sure to catch that presentation as well. And finally, I'm delighted to welcome for the first time to the Precious Metals Summit, Mr. Maron Katusa. He is a professional investor and founder of Katusa Research, and Maron is considered one of the most trusted and best connected deal makers in the junior resource sector today. So it's great to have you with us, Maron. I will leave it now to you in your capable hands and your capable voice to carry on and enjoy the conference, the rest of you guys. Cheers.
Thank you, Jessica, and thanks for everyone being on this and the opportunity. I wish we had it recording. The pre-live was pretty much the most entertaining way to start your day between Ross and Tom. So let's get right into it. We got a list of questions, then we'll take some questions from the audience. Both Ross and Tom, you've experienced the bear markets of the 90s and the early 2000s, and then you experienced the big money flow coming in from Warren Buffett, Bill Gates, George Soros, and the likes into silver. So my question for you now is, with the recent events of Berkshire's move into Barrick, how is this move similar, and what is different from back then and compared to now with the generalist funds and even the value investors coming into the precious metal sector? Tom, you want to start?
Sure. I think that what we're seeing now is the validation, or I should say the revalidation of gold as an asset class that sort of went into abeyance after the 1980s. Mm-hmm. And the advent of seeing so many bold-faced smart money names, the most recent of which is Warren Buffett, but he was preceded by Ray Dalio, Jeff Gundlach, Mark Mobius, brilliant piece by Mohamed Al-Arian in the FT. What we're seeing now is a massive transformation of the image of gold from being the asset that people loved to hate and hated to love, to being one that people are now saying, well, you know what? We should have a piece of gold in the portfolio. And you see it when you watch MSNBC or you watch CNBC. When gold used to be mentioned, you were essentially diminished as a troglodyte or a bug, whereas now people are more constructive. Now, contrarians might look at this and say, well, perhaps it's being overbought. But the reality is that gold is probably the most under-owned financial asset in the world. And what you're seeing with all of these new names coming into the picture is that when gold pops above 2,000 and starts to continue the ascent, which I think will take it many, many thousands beyond that, the fund managers who start looking at it will now have a whole raft of new names to use as validators for when they take gold to their ICs. So to me, it's wildly bullish and probably arguing for a perfect storm, a paradigm shift.
Ross?
Yeah, I mean, I don't disagree with it. I mean, you're going to hear this refrain, Tom, and I think very similarly on most things, I think. So I don't disagree with anything Tom said, but unlike the case of, say, Ray Dalio, who invested in gold and was extremely explicit in his writing about why he invested in gold, he had a very logical refrain about gold as an asset class and why it was undervalued and why it would go up. And that's the refrain of sort of the specialist investor or the gold bug, quite frankly. And that's that camp. But what I really liked about Warren Buffett investing in Barrick was that, Warren Buffett has slagged gold for 30, 40 years. He's never owned a lot of gold. He owned a little bit of silver back in the 90s, very briefly, and in a significant way. He thought the price was likely to rise, and he came in and he got out. But what Buffett did buying Barrick was, to me, a signal that generalist investors are looking for something in the gold sector that they haven't seen traditionally, and that is profitability. So Buffett felt, with the Barrick investment, is that it was an earnings-based investment. It was a profitability-based investment with leverage to the gold price, kind of secondary. And I thought that was a very bullish thing, because that's the same kind of thinking that brings the great pool of generalist investors into the space that has traditionally been lacking, especially in the last 10 or 15 years. There just hasn't been that generalist investment in the gold sector, in the equities. And so I'm quite encouraged to see that.
So on that note, Ross, with over 50% of the capital in the market right now managed by passive funds, that was not the case 20 years ago. And do you see that a major change for the generalist funds or even the value investors to say, hey, I'd rather play the GLD, which over the last 18 months has seen a $25 billion net inflow, versus the passive direct investments to the mining companies seeing a net outflow? How does that aspect of the passive management change from your view, from Tom's perspective of developing these companies and going towards production and increasing production?
Right. Well, that is something that is definitely different today than 10 years ago. The amount of what I call dumb money, dumb investment money, robot investors, the value investors are less powerful today. You have the quant funds and the people who only buy the ETFs. So what is different for the equities, for the companies that are building gold mining businesses, is that you now have to have scale, and it's what you get gets you into the indexes. Once you're in the indexes, of course, you are being bought every single day or sold every single day by that flow of funds into the ETFs. And so, as you said, the 50% of the investors who are not looking at anything fundamental, the companies, they just look at the general space. They go in, they buy the ETFs. Those ETFs then have to buy the underlying stocks that are members of those ETFs. So if you get into the ETF, you're happy and you're being invested by those pools of capital. If you're not in the ETF, you're lagging. And it was very much a strategy of mine starting Equinox Gold to build a company of scale so that we could get into those ETFs and access those large pools of capital that otherwise wouldn't look at us.
Tom, what about your perspective from the change of the passive management?
Well, first of all, Willie Sutton was once asked, why do you rob banks? And the answer was, that's where the money is. And I learned very, very early on in my experience that if the only focus is on the mining funds, then what ends up happening is that you cannibalize from other players. And it's extremely unpleasant. And truthfully, institutional investors don't really like to see companies slagging each other off. And my philosophy from the very, very beginning was to focus on generalists. When I got into the business, Soros was my partner. Bill Gates, through Cascade, came into Ross, and we were both playing silver. The advent of being able to have a Bill Gates or a George Soros as advocates within a mining vehicle was extremely unusual and very beneficial to both of us. And then you superimpose upon that the ultimate naysayer in gold, Warren Buffett, who bought 130 million ounces of gold the week I took my company public. Silver. Thank you. And that became the great detoxifier of silver, which theretofore had been tainted with, discussion about the Hunt bubble, etc. I believe, as Ross just mentioned, that what we're seeing is a similar phenomenon in gold. The ultimate naysayer has now taken a stake in a premier gold mining company. Whatever the rationale was, it's emblematic of the shift that's taking place. And this is why I think the indexes are going to benefit the mining companies. What we're seeing now and this is the beauty of gold, is that so many people are choosing gold for different reasons. I call it a buffet because you'll have Dalio, as Ross just referenced, arguing it from one area. Dalio said, look, gold is just another currency. Get over it. We have Aussie, we have Swiss, we have yen, we have euro, we have dollars. You should have some gold. And if you don't have any gold, quote, then it means you don't understand history or the business of gold. And he's right. I personally am particularly bullish on gold because being a professional in the space for almost 30 years, I know how dire the industry is and that production is declining. Grade has collapsed by 50% over the last decade. No new major discoveries are taking place. You know, Ross has been acquiring great producing assets. Our flagship Nova Gold is the next Carlin. I mean, it's half hours and half barracks. But we know that if you discovered something like a Donlin today, to get it to where it needs to be in production is going to be on average between 20 and 25 years. And that's assuming the discoveries are made at all. They're not. The majors are burning through their reserves faster than they can replace them. The juniors are not making big discoveries. The Donlins of the world are as rare as they can possibly get. So for me, having that kind of flagship is great. And we now have been added to one of those indexes because the market cap rose to that level. Equinox, that's going to be the same thing that happens there. I'm fine with the indexes because candidly, I genuinely don't believe that most people have the ability to really understand the arcane nature of what makes a profitable precious metals mining investment. It's really tough. And when I see the kinds of things that are presented to us on a regular basis, I can only imagine the challenge that's faced by the retail investor or the new institutional investor coming into it, which is why when people say, you know, how would you do it? I say buy bullion and also go to a smart portfolio manager, go to a John Hathaway who's been there, done that, seen it forever, a First Eagle, Fidelity has a great gold fund. Go to the people who are in the fray and know the difference between what's going to work and what's not going to work. They've done their work on jurisdictional risk, etc. Trying to figure it out on your own without having a dozen geologists behind you, as we do, I mean, it can be done, but I think there's so much money to be made just by simply finding the right vehicle and riding it that this is probably not the time to be too cute.
So, Ross, on that note, both you and Tom have had incredible scores in your past, but the key to making those big scores, as you've mentioned many times, is holding on during volatile times and not selling out for the Mickey Mouse gains. Now, you're both principals of your deals, so that makes it by default a lot easier for both of you to hold on because of your insiders, and you can't trade the stock like, let's say, a passive investor can. But what process or framework would you recommend for investors to go through to not sell too early and miss the big moves that we all believe will come? Ross, first you.
Sure. All markets are cyclical. So human nature creates that, the great cycles of fear and greed and world events and so on. But gold is another market, and it does follow cycles. And, I think to understand those cycles, you have to do a bit of learning of history. You have to go back a long time and understand how human psychology works. Because when you're in a cycle, you're either in a down cycle or an up cycle. But in either of those cycles, if you're in the middle of it, you can get a lot of fakes. You can get a lot of head fakes with this market is changing now. Don't trade. But if you're in the middle of the cycle, you want to be trading. You want to be trading for that 10%, 15% jump. You sell and then you buy down when it collapses. In that, for example, a bear market, if it goes down and down and down and down, it always goes down for a long time, maybe 4 years, 5 years, depends on the specific cycle. And in that market, if you stay long, you get crushed, absolutely crushed. So you want to be kind of out and understanding when these cycles are going down. You do not want to be investing for sort of an invest and hold kind of strategy. But the real money is made in this business when you have the bottom of the cycle. The real money. I mean, it sounds so easy to say, buy low, sell high, and it's so very hard to do. And yet, some people manage to do it repeatedly, and I've been lucky enough to be in that category. And I I really just it doesn't seem to me to be terribly clever because in these cycles, and I could list a whole bunch of other people who tend to do it well. I'm not so much buying at the bottom of the cycle. I'm trying to buy assets to build companies in that time, whether it's copper or gold or silver or whatever metal you have. When things kind of just feel like there's a shakeout and there's a debacle at the bottom and everybody's crying and miserable, truly that is the time to get in. And when you get in on the turns of these cycles, I mean, do not sell too early, because what has been, a horrible trend on the way down all of a sudden becomes something in which you should recognize secular changes, a very big shift, a breakout one way or the other, or something different today than was the case yesterday, because the big money is made when those turns come, or at the low end of those turns in the first few innings of the new market. And if you are unlucky enough to not recognize that, you may think you're going to get a 15% gain and pat yourself in the back, but you're losing out on the 400 or 500% gain that comes in this sector when the tide starts coming back in. When the tide comes in, it floats all ships. Anything with gold or silver in their names will double or triple or quadruple. You'll get 10 baggers. That's the time to stay long, and that's the market we're in right now. We've been in this market now since the beginning of 2014. Normally, it would be rather longer in the tooth. For example, this could be the fifth inning or the sixth inning of a gold bull market. But then COVID came along, and this insane monetary easing globally has just put gasoline on the fire. And now this game's going to go into extra innings for a very long time. So I think it's not the best time to invest today, but it's certainly not the worst. We're in the secular multi-year trend. If you own any gold and silver stocks, and you're able to do it, put them away. Just forget about them, and a year or two from now, you're going to wake up happy.
Tom, what about yourself as advice to investors? Would you suggest focusing on NAV at a discount to gold? At what point, for people to still say, hey, what I'm owning is still cheap on a fundamental and relative basis, or what metrics or framework would you suggest for investors to use?
I should probably preface my response by saying that this should have a warning: children, don't try this at home. I don't tend to use PNAV. I don't tend to use, obviously we use them as reference points, discount rates, et cetera, et cetera. My mantra has been from the very beginning, go for category killer assets. It's all about the assets. You want to be able, for years, my mantra was, I'm looking for assets that give me great leverage to an underlying theme. It worked in silver. We had a 200x return, 200 times our money. Then 100x in PGMs, then 100x in hydrocarbons. The common denominator amongst all of them was that the assets would qualify as category killer assets, assets that in principle anyone would want to own if being given the opportunity. When you believe that you have those kinds of assets, and our minimum objective when we buy into something is that if we are successful on the assets themselves, we will make 10 times our money. Then we superimpose onto that the fundamental analysis on the underlying asset class, whether it's silver or PGMs or hydrocarbons or gold. And we say, if we are right on the fundamentals of that asset class, can we make 100 times our money? And we have in silver and PGMs and hydrocarbons, and I fully expect the same in gold. Now, I'm not saying that to be, to be audacious. It's simply because this is a fact. We're not traders. So over the course of the last 27 years, during that time, we've had a 70% annual compounded rate of return based on buying the right assets. Now, there are some times when during the course of the year, you'll see things go up, tenfold. And then there are other times, like the past 7 or 8 or 9 years, where it's like watching paint dry or worse. We tend to adopt a buy and hold strategy. I'm a historian by background. Ross is a geologist. I surround myself with geologists and engineers. But
I don't surround myself with historians.
Pardon?
I don't surround myself with historians.
Other than me. Other than look what I've added to your life, man.
Yes, so, I know.
Yeah, I know. Oika Vol. But from my standpoint, it's about patience. And I can't exactly say that this lesson is fungible because I've never been burdened by having shareholders or co-investors who've put a gun to my head. If I've told them it's going to take 10 years, but we're going to make 10 times our money, their attitude has been, okay. Obviously you want to truncate that. Sometimes it's far shorter. Sometimes it could be a few years longer. I think that what we're dealing with now are the early innings of the next wave in the bull market. Wave 1 took us up for 12 years in a row. Wave 2 took us back down to 1,100. Wave 3, I think, will take us to between $3,000 and $5,000. And Ross's advice is right. Take it, put it away. If you could be cryogenically frozen for the next year, you'll make a killing. There will be volatility, but the scarcity of great assets in the precious metals space means that you're going to have a huge wave of money coming into these things for a variety of reasons. Some because of inflation fears, others because of deflation fears, some because of the state of the mining industry, others because of deep currency debasement, you name it. A flood of money is going to come into very, very, very few names. So you want to be there. You want to close your eyes and say, I'm going to ride this wave because this is where we are. And for those who are going to be buying bullion, 2000, yes, you could have bought it at 1200 last year. But I'm going to tell you something. If you'd bought the Dow Jones in the early 1980s at 1200 or 2000, on its way to 30,000, it really didn't matter. Buy it, hold it, dollar cost average if you want. This is the generational trade, in my humble opinion, and that's where my family has its money. I don't have to. I could be in anything I wanted. I could go into widgets. I could be buying property next to Ross in Vancouver and just driving him and Trisha crazy.
You'd be happier.
Actually, you know what? Yeah, you're probably right.
Okay, so
not that you're not happy, Tom. I don't want to suggest you're the least bit unhappy. In fact, you sound sort of giddy most of the time, which makes me wonder, what are you doing over there in Saint-Tropez?
I'm not arguing. Like you, I live in a bubble. In fact, I always use your expression, Ross. I'm a Babylonian. Thank you.
Okay, on that note, Ross, portfolio allocation is a difficult item for many to manage, especially generalist investors, retail or high net worth. What percentage, Ross, of your net worth is directly exposed to resources? Then breaking it down further, what percentage is broken down between physical bullion? Give us the ratio of gold to silver, gold equities, and silver equities.
Well, I've never been asked that question, Maron, but just sort of thinking off the cuff, certainly 90% of my net worth is in resources. But don't forget, I started a renewable energy company a few years ago, and I still own almost all my shares in it, and that's a significant chunk of my resource portfolio, maybe 20%. So the balance is 60 to 70% is resources, and it's specifically gold and silver. I mean, a little bit copper, a little bit other stuff, but almost entirely gold and silver. I don't own a single penny or almost no penny in gold bullion because, of course, I'm not an investor particularly. I'm a developer. I'm a guy who builds companies and operates companies. And so these are all precious metal companies today because I happen to love precious metals, and I think the sector is great, and it's a wonderful place to be, and it's done incredibly well in the last while, of course, for everybody. And the reason I don't own bullion. Bullion is perfectly fine for investors, but again, I'm not an investor. And so almost all my net worth is tied up in my own companies that I've founded and built, including the renewable energy business. And really, if you are bullish in a metal, if you're bullish in a metal, you get the leverage with the equities. You get the leverage with the good equities. And so, anybody who is in this space as an equity investor should buy the equities. If gold goes up 10%, the equities are going to go up 20 or 30%. That's what, especially the good ones that have large exposure on both the income statement, which means production, to a rise in, say, gold, but also who have great exposure on the capital side, on the balance sheet, which is the resources in the ground. And I mean, that's where, for example, a NovaGold is got great value because it has this massive capital asset. Every $5 or 5% increase in the gold price is worth, hundreds of times that to the actual intrinsic value of that company. So that's why I'm invested in equities and not just bullion.
So before I go to Tom, Ross, just because we're friends, so I'm allowed to put you on fire. Does that mean 10% is in cash, the remaining? Are you mainly reasonable?
No, it's 10% cash. I don't know where it is. To be honest, I don't really exactly know if those
5 billion
are right.
here, 10 billion there.
Yeah, I mean, it's kind of like that. I'm not a really. I don't count my money every day, so I don't really know what it is. But 90% in resources. That's the bottom line.
Tom?
I'm not an investor. Don't forget.
Tom, same questions for you.
So, thank God for Ross because he's so much more precise. Hey, bless your heart. We don't invest in funds. So our family office is entirely dedicated to our natural resources investments, which I would say are now 90%, 95% precious metals, probably half silver, half gold. In terms of as a percentage of my net worth, some of those assets are private and I don't really know, we'll see what they're worth. They're obviously worth a lot. But our flagship in gold is NovaGold, and our stake in that is about $1 billion on our balance sheet and those of the sovereigns who are with us. So I would say, certainly at least half. There are other stuff that, we do. I have, some expensive hobbies. But I would say all of our business exposure is precious metals. All of our business exposure, because it's the only thing that I believe in. And that goes back to that question. If you believe in something, if you have conviction, then bear markets are buying opportunities. And not things that shake you out, but things that, shake you up in a good way. And so, we're all in on precious metals because that's the way I believe I can preserve my family's wealth. And because like Ross, we're professionals. Ross builds companies. I mean, you've seen it, Pan American and Lumina and now Equinox. And, we and all the things that we've done in the various areas, we know that that's where we get the leverage. I'm not going to get 100 to 1 in the bullion. There's nothing wrong with that. And for those who are timid and who are not, don't look upon volatility as an opportunity, but as a source of anxiety, I say, sure, buy the bullion and you can buy the ETF. If there's nothing to back GLD, then gold is going to, even higher prices than I would imagine. But, I would say for the average investor, they should have somewhere between 10 and 20% in precious metals related assets. Ross and I are professionals, so we're more comfortable actually with things that can't be traded easily, where we're basically strapped in, like good kamikaze pilots, and we're going to take the trip one way or the other. I found that illiquidity is one of my best friends. And, if I'm in until the end. And so, other people can't take that position. But if they do, I recommended to David Rubenstein about a year and a half ago. He asked me that question, and I said, 10, 15, 20%. He said, would you buy silver? I said, yes, but just understand the nature of silver. It's going to be more volatile, but ultimately it will likely outperform.
So, Tom, what percentage?
That was a very precise answer, Tom.
Well, I want to dig in a bit. I want to dig in a bit deeper. So, yes, you're a professional investor, and the whole point is to learn from two legends in the business. But what percentage of bullion is your resource portfolio?
Very small. Okay. Very enough to be able to get me on a private flight to go and hunker down with Ross and Tricia. That's basically all that I need.
Okay, thank you.
Simple.
It's
simple
really
man. Really simple man with simple needs.
I'm a man of simple needs. Get me to Ross's.
You can't come here, Tom. We don't allow Americans into Canada. Sorry, pal.
No, you, Bob Quartermain, and I, Brotherhood of the Ring, baby.
Whatever it is. Okay.
So the next question, Tom, I'm going to run with you on this one. Okay. Does the results, either way of the U.S. election, I don't want to get into who will win, but does either outcome change your price outlook for gold in the near term, meaning within 12 months after the election and post 12 months, Tom?
And you only have 20 minutes, Tom.
Yeah. We have 15 minutes to go through another 10 questions. So,
okay. Let me put it like this. First of all, I don't think it matters. Leg one of the gold bull market, 12 years, gold went up every single year, regardless of inflation fears, deflation fears, strong dollar, weak dollar, strong oil, weak oil, political stability, political instability. I think we're going to be in one of those long waves. And to me, it's all about extrinsic issues, whether the Republicans who spend money like water or the Democrats who spend money like water, it doesn't matter. I don't even think COVID matters. In fact, I actually think that COVID may actually have stopped temporarily gold's long wave. I mean, we were up to 1,600 before COVID. And I think what COVID is going to do ultimately is to accelerate our move into the new equilibrium zone that I see. But ultimately, it's all about all the fundamentals, and the politics aren't going to matter. Republicans and Democrats are both aligned in one important thing: spending money that we don't have anymore, period. Assuming that indeed money has any value anymore. I don't think Republicans believe it, and I don't think Democrats believe it, which is yet another reason you don't have to be politically motivated to just say, you know what, in a world where everyone wants to debase their currencies and nobody really cares about whether money has any intrinsic value, you've got to own some gold. Well, here's the thing. If 1% of gold goes into portfolios, into all of that passive money, gold multiplies. There's not enough to go around, and the mining companies are never going to be able to provide it. That day is gone.
Ross, same view?
Yeah, pretty much same view. I might feel differently if there was much of a difference in the love of debt between Republicans and Democrats, but I really don't see it. And it's not just the United States. I mean, pulling out of the U.S., look at Japan, look at China, look at Canada, look at Europe. There's just this binge going on. People have gone crazy. Central banks have gone nuts. People don't understand the notion of debt, which is that it should be repaid, and somebody has to repay it. And the only way to repay it is to inflate your way out of it, to debase your currency, or to collapse and default. And I mean, that's it. And I don't see a growth saving us from this problem the way it did, say, in the 50s or 60s. It's just we're in a low growth world right now. Governments have gone crazy, and gold is going to be a beneficiary of that. But there's going to be a lot of unhappy, miserable people out there, whether it's a Democrat win or a Republican win in November.
Tom, this next one's for you. What do you say to
Wasn't
those
that concise?
That was great. That was great. So, Tom, what do you say to those in the market that believe silver is not a real precious metal and it won't have the rise that gold will have because it's kind of one foot in the precious metals, one in the industrial, and then I'll get Ross's take after.
Why don't we speak together? Go
in
ahead,
harmony,
John.
please. In harmony.
I can do that.
'Cause
Look, they're right. Silver won't perform like gold. It will outperform gold for simply the reason that it has an industrial component. But in a bull market in gold, for its precious metal or monetary metal characteristics, typically what happens is exactly what we've seen this year. Because of the industrial component, silver takes it on the chin when there's a financial crisis or an economic crisis. Silver went down to 11-ish, and now it's at 30. So it's outperformed gold. What happens is silver takes it on the chin. Then as gold gathers momentum as a monetary metal, silver catches up, and then it ultimately outperforms it. That's going to happen here as well. But, to the idea that silver's industrial component is somehow a liability, it makes no sense. In a bull market in silver as a monetary metal, investment demand will dwarf industrial consumption. But the truth is that because silver has so many unique properties, its malleability, its reflectivity, its antibacterial, conductive capabilities, so many things. And the truth is that nobody's going to substitute for those things unless they go into gold or PGMs. So when silver's going up as a monetary metal with gold, the industrial buyers have to come in for a certain percentage of that because the opportunity cost is simply unavoidable. So, if you were talking about zinc or lead or copper, or iron ore, things like this, I would perfectly get it and I would agree. But for silver, that industrial component is like kerosene on a fire.
Ross, music to your ears.
No, it's exactly what I would have said, but perhaps less eloquently. The funny thing for me in silver, I've talked about silver more than gold because of course Pan American has been around for 27 years and Equinox only 2.5 or so. So and in the 90s when Tom and I were both in the silver game and I started Pan American in '94, I was like, I knew everything there was to know about silver because I knew very little. Ignorance is bliss, and I could make a great speech about silver. And I was positive and I was persuasive that silver, which was then at $5 an ounce, was going to go to $10 by the end of the decade for all these 52 different reasons. And of course, needless to say, by the end of the decade, silver was trading at an all-time low of $4 an ounce. It had gone down, not up. Mercifully, we'd build a company around it. But I just, it's hard to predict these metals conclusively. But I think what Tom said is absolutely right. If you look, because silver is first of all a much thinner metal, much less liquid metal than gold. It's about 1/10. It trades about 1/10 the amount of gold on a daily basis. It's both industrial and precious. So you've got to look at both fundamentals for both markets to understand what's going on in silver. But it's therefore somewhat predictable. If there's an industrial metals are doing well and precious metals are doing well, silver is going to outperform. It's going to be the very best performer of all. And we've seen that again and again in the last 30 years. On the other hand, if you have an industrial depression or recession, silver is going to be hurt. The industrial demand will go down. But typically in many of those times, you're going to have a good market for precious metals. And so silver is going to be in the middle somewhere. And if you have a terrible market for industrial metals and a terrible market for gold, then guess what? Silver is going to underperform everything. And that has happened. So, that's what's going to happen.
So let's take the framework that MMT is here to stay for many, many, many years. It's massive stimulus. Remember, the central bankers don't view debt as the debt as you traditionally view, Ross. It's digits that are an investment into the community that will be retrieved through taxes. So it's just a digit on the ledger. Yep. Would you say with that massive stimulus coming that silver by unit is a cheaper or more value metal than gold is today?
Okay, if you assume that modern monetary theory is going to be with us for many, many years, I don't think it can. I think it will end up in complete collapse of our financial system if that's the case. But if you assume that's the assumption, it's going to be with us for many years, then yes, it will stimulate industrial demand, most probably with the amount of money that's going in that can buy things and fund some sort of growth, however dependent on debt it is. You're going to have good markets for industrial metals and a very, very receptive environment for precious metals. So silver will outperform gold.
Tom?
Yeah, I think that sounds right.
Okay. So now we've got 5 minutes before we take questions from the audience. And if we don't have questions from the audience, no problem. We've got lots here. So I can only imagine sitting back in the 90s with you two on stage pitching your skills. But looking back at your career, and this has been an honor getting to know both of you very well, what would you have changed both professionally looking back? Like if you could do a redo, Ross, for example, focusing on bigger assets rather than Mickey Mouse assets because of the time factor. And then we'll get into the personal aspect next. So what would you do from a career redo?
Tom? What are you going to do? Do you want to?
Oh, sorry, Tom. Let's start with you on that one.
I thought you were going to.
Well, I'll tell you. It's a great question, and I've given it some thought as a consequence of this session. And I'm always very reluctant to suggest I would have changed even one day in my life because it turned out to be so much more rewarding. My life turned out to be so, to me, astonishing. I mean, if I look back on it when I was a teenager and I said, this is what's going to happen to you. And the 50s guy looked back upon the teenager and said, this is what's going to happen to you. I would have said, no, you're kidding. Please, whatever you do, don't F it up. So I'm very reluctant to change anything. But if I could change something and it would have had no butterfly effect on my personal life, I've been with my wife for 32 years. My professional life has been ridiculously fortunate, blessed, lucky. La Fortuna has been extremely kind. If I could do one thing, one change would be that in the late 90s or in the early 2000s, I would have gotten to know Ross. By the way, this is extremely serious. It's extremely serious. And, normally I should pay someone for this kind of therapy. But the reality is
me.
Ross and I, saw each other as competitors in the 90s. Ross is much more competitive than I am. He's also
I don't know what that word means.
No, he's a much better businessman. So Ross can do deals. I've never been a deal maker per se. I rely on trying to be early and ridiculous luck in the drill bit. But had I been able to meet Ross and get to know him, which only happened because of lunch that Ross and Bob Quartermain were having, and Bob had just come back from visiting a Jaguar project, that Panthera, in which now the three of us are directors, and that's our big cat conservation organization. But, Bob was down there with me, and he was telling Ross about it, and Ross said, why were you there? And he said, well, Tom took me there. And Ross said, what does Tom have to do with wildlife conservation? And he goes, he's as passionate about it as you are. Ross is one of the foremost environmentalists and conservationists in North America. I didn't know that. He didn't know about me. If we'd met in the 90s, I would have had the best of all possible worlds because the San Cristobal asset that we discovered was absolutely gorgeous, absolutely brilliant. And I wish that he'd bought it. And he was it would have been perfect. It would have been great for Pan American, would have been great for us. It would have been brilliant. But more than that, instead of waiting decades for Bob Quartermain to really introduce us properly, now that we are literally, the three of us have this ring, which embodies our shared passion for big cat conservation and wildlife conservation. If that had happened decades ago, I would have accomplished more in every field. And I would have found the brother that I ended up finding decades later, for which I'm eternally grateful to Bob and eternally grateful to Bob. If I could change one thing, it would have been that. And that's the truth. I can't think of anything else in business I would have done differently.
Well, there's nothing like the truth. So help me God.
Ross, what about you?
I mean, I'm just going to wrap it up. I think here it sounds like I guess I've made more mistakes than you can imagine, Maron. Spending 3 years in California in the late 80s permitting a gold deposit called Zenda that had a total gold resource, total 45,000 ounces. But we were going to build a mine there, and we spent 3 years permitting the bloody thing. And we finally got our permits. And then I realized, 15,000 ounces a year for 3 years, and then we closed the mine. It's not a very good business proposition. So that was that was one of 100, dumb decisions, terrible mistakes. And this is the school of hard knocks. You sink or swim, and every day's a new day. And, you don't have mentors. You don't, like Tom hasn't. Tom's been incredibly lucky. I guess I would say the same as Tom. You just have to set yourself up to have luck and then cross your fingers. The harder you work, the luckier you get. You work hard, you make the calls, you tell stories, you raise money, you cross your fingers and hope you find things. You go into places that most other people wouldn't go. You hold your nose, you cross your fingers again, and sometimes you get lucky. And investing in Peru in the 90s was a case of that. It was a total sea change from the early 90s to the mid 90s. Great place to go, and it still is great to this day. We ended up going into Russia 3 more years, ended up in a complete debacle, and I wasted literally 3 years of my life and an immense amount of heartache. It was such a tough place to work. So lots of mistakes. At the end of the day, I can't really put a formula to success other than work hard and play hard. Remember your family. Like Tom, I've had one wife for 40 years. As poor, suffering wife as she is. But, you remember your family, and you remember your work and work with good people and have fun together. And then for me, it's also been about me. I've done a lot of very selfish things, selfish travel, selfish fishing trips and stuff like that. But it's kept me sane and allowed me to kind of keep all the balls in the air. And so far, none of them have dropped. And that's what's worked. It's been a great advice. Late in my career, I got very heavily involved, as Tom said, in philanthropy, and I've been very active. And funnily enough, the more I give away, the more the rest of my assets manage to grow. So it's a strange connection there. And so I'm really focused hard on environmental philanthropy right now, and that's probably where I'm going to end my days doing more and more of. It gives me a lot of pleasure. It's a lot of fun to make money. It's a lot of fun to give it away.
So Tom, how could everyone watching this, that there's a complete truth to the power of giving, learn more about Panthera and what you, Bob, and Ross are doing? Where can they go? Direct us.
Well, you'll find us just Google Panthera, and we're the first thing that will come up, and you'll see the 3 silver amigos as directors. I'm chairman. Done everything I could to try to seduce Ross to be chairman because he'd be awesome. So maybe peer pressure, send in, notes to Ross. But the reality is that, we're now the leading NGO in wildcat conservation globally. We're in over 50 countries with 100 partnerships, everywhere from Mexico to Mongolia and Tanzania to Tajikistan. And that really is the joy of my life. I've got a lot of things that I've loved doing, passions, extrinsic from my family. But wildlife conservation is the one where when I wake up in the morning, I know that I've got a life that's good.
That is fantastic. So I'm going to take some questions from the audience, but before I do, I want everyone to, this business is all about the people. And I think follow Ross, you follow Tom. Bob Quartermain would have been an incredible addition to this panel. I think that is an absolute gentleman and so smart. So if you ever get to meet him at a conference, make the effort. And he's such a down-to-earth guy. Just a reminder, Equinox today at 3:45. That's something that, look, I've got a huge position in it. I'm a big believer in the team and Christian and Greg. Nova Gold tomorrow at 3 p.m., also a must view. There is one question here, Tom, that I think is quite it made me smile, at least. Tom, which will appreciate more in the next 20 years, Nova Gold or the Storm of the Sea of Galilee?
Okay, well, the Storm in the Sea of Galilee, of course, was stolen. So who knows what became of it. But I would say with regard to Nova Gold, it's our flagship. And I think, it's going to inure to the great benefit of Barrick shareholders who own half of it, and to Nova Gold shareholders who own half of the Donlin deposit. It is unique. Donlin is quite simply unique in terms of its size, its grade, its mine life, its operating costs, its geographical safety. For us, it's the perfect way to play gold. I would not be remotely surprised to see it, go 10x up from here. Or Equinox by the way. I mean, you've got, Ross Beatty, whose track record is fabulous. If you're going to be an investor and you can't buy the Sea of Galilee, then you do worse than to follow people who are clearly putting significant net worth into a story, and you can research that. Or you can buy, through ETFs. But I think anyone who buys Equinox is going to do well. I'm chairman of Nova Gold because to me, Donlin is the greatest gold asset in the world, and it's in the safest part of the world. And I love working with the management team. So if I didn't, I just wouldn't do it. I mean, there are companies which we own 70% of. I don't even sit on the board. I don't feel, I need to, but also because it's not going to be very fun. And at this point in my life, I can afford that. Between Rembrandt and Nova Gold, let's put it like this. I think that Donlin, whether you buy it through Nova Gold as a pure play or through Barrick, Donlin is a Vermeer. Donlin is a Da Vinci. Even it's that rare. You'll do fine.
Well, both of you guys are rare breeds in themselves. It's been an absolute pleasure. I think we'll end it on that note. Ross and Tom, thanks so much for that.
Okay, Maron. Nice chatting.
Thank you very much. That was a great pleasure.